afternoon.
I'm about to call the meeting of the Joint Subcommittee on Tax Policy to order, and I'm going to ask if we can do a roll call so we know exactly who's here today.
Okay. Senator Saravel.
Here.
Senator Obenchain.
Here.
Senator Eben.
Here.
Senator Locke.
Here.
Senator Deeds.
Present.
Delegate Sullivan.
Here.
Delegate McNamara.
Here.
Delegate Watts.
Here.
Delegate Austin.
Here.
Delegate Sickles.
Here.
Delegate Torian.
Here.
And Madam Chair.
Here. Thank you. Well, the Joint Subcommittee authorizing statute provides for the election of a chair and vice chair annually, and I will now accept the nomination for the chair.
Try to turn this mic on. Madam Chair, I would like to nominate Senator Lucas as chair of the Joint Subcommittee.
Second.
Well, thank you. I didn't even need to ask for a second. All those in favor say aye.
Aye.
No, you have the same right. I won't be offended. Thank you. Thank you all. I look forward to serving the Joint Subcommittee over the next year as its chair, and I will now accept nomination for vice chair. And I would like to nominate Delegate Torian for this role. And I got a real quick second. All those in favor, please say aye. Aye. Thank you so much. Next, the Joint Subcommittee needs to adopt a remote participation policy, and I will ask Stephen Kitterman from Legislative Services to state the policy, and then I will ask for a motion.
Madam Chair, the draft meeting policy, remote meeting policy includes two parts. The first would address remote participation by individual members during in-person meetings. There are 4 occurrences where that can happen: disability or medical condition of the member, for a family member if the member lives 60+ miles away, or for a personal matter, and there are some additional limitations on using personal matter as a reason for remote participation. The second part addresses all virtual meetings. We're limited by law to 2 electronic meetings per year or half of meetings held. This draft meeting policy incorporates legislative updates from the 2024 session, and I think mirrors pretty much every other meeting policy adopted by other interim studies and commissions. Madam Chair.
Thank you. You've heard the remote participation policy. I need a motion to approve.
Madam Chair, I move adoption of the remote participation policy.
There's a motion and a second that the policy be adopted. All in As we negotiated a budget between the state, the Senate, and the House, we initially agreed upon modernizing our sales tax to include digital goods. However, this agreement was put on hold so that we could get the budget in place prior to the start of the new fiscal year. Although the governor initially proposed the sales tax modernization, he eventually opposed it since his reduction to the individual income tax and increase in the sales tax rate were not going to be adopted by the General Assembly. These actions would have predominantly benefited our wealthier citizens and undone our work to make the income tax more progressive. I hope Governor Youngkin will join us in modernizing the sales tax base as a bipartisan tax policy legacy. Let's close the tax loophole that allows an e-book to go untaxed while the same physical book is taxed. This is just one example where our tax code applies inequitable treatment solely on whether the item is tangible personal property or digital. Our sales tax base should reflect the goods and services consumed by Virginians, and it is long overdue that we apply the same rules to digital goods and digital services. House and Senate leadership agreed that this group would meet this year and examine the fairness of our individual income tax system and explore efforts to modernize the Commonwealth's income and sales and use taxes. These efforts will also include a look at long-term revenue growth in our efforts to ensure that we have sufficient revenues and sufficient revenue growth to maintain our core government services. Today will be an introductory meeting where we will have a presentation from staff on our revenues, presentation from tax on Virginia's tax policy, and then we will conclude with a presentation from JLOC staff on their study related to income tax progressivity. Now I would like to turn it over to Tyler for the first presentation.
Madam Chair. The first presentation is on the Joint Subcommittee Work Plan and an overview of Virginia's revenues. Madam Chair, as you mentioned, the Appropriation Act directs the subcommittee to explore options to modernize the income and sales and use tax. Your specific goals and objectives that are laid out are evaluating the existing exemptions for sales and use tax, applying sales and use tax to digital goods and services, evaluating efforts to increase the progressivity of the income tax and the long-term revenue growth for core government services. The proposed work plan from staff detail the first August meeting, which you've described, Madam Chair. The October meeting, the goal would be to evaluate the existing sales and use tax exemptions and then focusing on the sales and use tax on digital goods and services. And then the following November meeting, a review of long-term revenue growth to maintain core services, and a discussion of any legislation referred to the Joint Subcommittee. The next slides detail the bills that were referred to the Joint Subcommittee on Tax Policy. I won't go through each bill, but I'll note a lot of them are related to standard deductions, subtraction of income for certain public service employees, sunset dates for the standard deduction, tax brackets for the income tax, child tax credits, and then sales and use tax. And a big focus on the sales and use tax is the additional tax authorized by localities to support school construction. Now turning to the revenue portion for the overview. So looking at sources of revenues for Virginia's budget, typically staff defines revenue as either general fund or non-general fund. General fund revenues are the more flexible that can be used for education, healthcare, public safety, and social services. The three largest are the income tax, the sales tax, and then corporate tax. And then non-general fund revenues include federal revenue, tuition and fees, gas taxes, lottery profits, unemployment taxes. These are typically earmarked for specific programs such as transportation or K-12 for lottery. A key fact to remember for the general fund is the revenue for the general fund is highly dependent on the individual income tax. It makes up about 70% of your general fund collections, with the next component being the sales tax making up in the last fiscal year the fiscal year we just completed, fiscal year 24, 16%, and then corporate income 6.5%. So roughly individual income, sales, and corporate income taxes account for 90% of your general fund revenue. Compared to other states, Virginia is one of the states with the highest reliance on the individual income tax. So looking at fiscal year 2021 collections from all the other states, Virginia is the fourth highest reliance on individual income tax. The highest is Oregon, Massachusetts, and then Georgia, and then Virginia. And then you can see our reliance on corporate and sales and then other taxes. Important to note on this slide is this is all general fund and non-general fund tax revenue as collected by the Census Bureau. The next key fact to remember about our individual income tax is that the individual income tax strength is volatile and it's highly based on non-withholding collections. Non-withholding collections are capital gains, interest, dividends, proprietary income, and you can see that that yellow bar is the non-withholding year-over-year growth, and that really can drive your individual income tax growth, positive or negative, whereas the blue line is withholding and it is more stable and less volatile. And it never has dipped below zero or negative growth at all in this time period. The next slide, on slide 12, this is revenue growth over time. And so you heard today from the Secretary of Finance that since 2019, general fund revenues have increased 40%. But when you adjust for policy and inflation, general fund revenues have increased 20% since 2020 or 21% since 2019. This is about 3.8% compound annual growth rate since 2019 or 4.6% since 2020. And you can see in those pink and magenta lines, those are the inflation plus policy adjustments. And so you can see for fiscal year 24, there's a decline in general fund revenue growth adjusted for inflation of 1.3%. And this is adjusted to fiscal year 2017 dollars. The next section is recent policy actions and a recap of the session that we just finished. This slide is the same slide presented to you today by the Secretary of Finance that details the revenue impact from major tax policy actions, the largest component being the increase to the standard deduction that happened in two phases, one going from $8,000 and then the second going up an additional $500. But you also see the impact of eliminating the sales and use tax for groceries. You see the refundable earned income tax credit, and then you also see the military retirement subtractions. And then at the bottom half of the table, you see the reminder for the tax rebates that were done in both 2022 and 2023. For a recap from the session, as Madam Chair mentioned, a large focus was on the sales tax proposals put forward by the governor. The governor proposed to expand the sales tax to the new economy categories, which included digital download, streaming, software services, website, and data storage. He proposed those to apply only to business to consumer, and then also increasing the state sales tax rate by 90 basis points, and you see the revenue impact. The House and Senate both maintained the sales tax to new economy categories while removing the increase in the basis points for the sales tax, and then also the income tax proposals from the governor. The Senate applied the sales tax not only to business to consumer transactions, but business to business transactions. And then the negotiated budget and the conference of the regular session, the General Assembly agreed to keep the sales tax on business to consumer and then applied the business to business purchases of software application services, so services such as Microsoft 365 or SaaS. And then by the time of the reconvened special session, the negotiated budget removed the entire sales tax to new economy categories as withholding collections were performing stronger, and you could revise revenues up by $525 million. Madam Chair, that concludes the overview on the work plan, and staff is happy to take questions.
Thank you, Tyler. Now I will call on Kristen Collins, the Deputy Commissioner for Virginia Department of Taxation.
Madam Chair?
Oh, I'm
Could I
sorry,
ask-
I didn't ask for any questions. Any questions by any member of the committee? I'm sorry, I wasn't trying to
That's okay.
just, okay,
May I, Madam Chair?
absolutely,
Question for Mr. Williams?
absolutely.
Thank you. Mr. Williams, I was looking at slides, I guess it's 9 and 10. And two questions. One, Virginia's listed here as having, on 10, 21.6% of our revenue coming from other sources other than sales, corporate, and individual. On the prior slide, just looking at last year, it's more like, looks like it's more like consistently sort of in the 8% category. Can you tell me why, what else is in this 21.6%?
So the biggest difference is on slide 9, this is the general fund other, so that has interest income. It also has other smaller collections in there, whereas on slide 10, the other category includes most of the non-general fund taxes. So that includes
Federal.
it includes taxes such as gas, alcoholic beverage sales, things that aren't readily comparable across the states. And on slide 10, we're trying to highlight the individual, corporate, and sales because those are the three main general fund sources for Virginia. And it is difficult to determine what other states deem as general fund versus non-general fund compared to Virginia as well.
Quick follow-up, Madam Chair.
Delegate Sullivan?
Well, you may have just answered my question, but I was interested in what you could tell us, if anything, about what was in the other category for these other states, particularly the top 10. And I think you just said you really can't, don't know.
The data will show you, Delegate Sullivan. So example for Montana, they probably have severance tax, and they also have property tax at the state level. So those are kind of key distinctions for them. And it does vary by other states. West Virginia is the same way. Severance would be a big tax for them compared to Virginia. West Virginia only has it at the local level.
Great. Thank you, Madam Chair. Thank you, Mr. Williams.
Questions by any other member of the committee?
Madam Chair, Servo down here.
Senator Sorvo?
Thank you. Tyler, I just had a quick question about the interplay of slide 12 and 14. So on 12, you showed the revenue growth since 2010.
Yes.
And in the last 3 years, you showed that, I guess on an inflation-adjusted basis, revenues have actually declined since 2022 on an inflation-adjusted basis, right?
On an inflation-adjusted basis, Senator Serval, they declined in 2023, and that's probably largely due to policy actions. But when you apply inflation plus policy adjustments,
That's what I'm getting at.
Yes.
Madam Chair, further question. So my question was, the declines that we saw in 23 and 24, seem to align perfectly with the policy adjustments you have in 14, where there's a $1.5 billion reduction in annual revenue from the policy adjustments, whereas if you go back to slide 12, it looks like the decline in revenue from 22 to 24 is about 1.5 billion. So I guess my question is, if we had not made those policy adjustments, our revenues would have been, I guess, what, flat on an inflation-adjusted basis?
Madam Chair, Senator Serval, if you didn't do the policy adjustments in 23, you would have had a decline of 50 basis points and a decline of 1.3% if you,
About $50 million a year?
yes.
Okay.
Other members of the committee?
Madam Chair,
Senator Senator Adams?
thank you.
Everett?
I wanted to, I don't know if this is the proper place to bring this up, but I'm concerned about, we're talking about state taxes here, but I'm concerned also about the loss of local revenue from commercial property tax due to office occupancy rates. And I don't know if this is the proper place to ask, Madam Chair, but is that something that we're going to look at some point, this committee, or is that beyond our purview?
I'm not sure it's beyond our purview, but I think we can get staff to help us figure it out.
Okay, well then the question to Tyler would be, for a future meeting, perhaps we could see how collections are going on commercial real estate. I know in Northern Virginia particularly, there's been higher vacancy rates and buildings selling for less than they cost initially. Thank you.
Thank you. I'm sure staff will get back to us on that one. Questions by any other member of the committee? Delegate Watts?
Thank you, Madam Chairman. If in fact we are going to go into, as Senator Evan requested, what's happening currently in commercial real estate, may I also request that we have at least a comparison state to state. Taxes on our local structure of taxes rather than just the isolated economic issues having to do with commercial real estate.
Staff taking a
Madam Chair,
Tyler?
Madam Chair and Delegate Watts, we'll look for data from that on the Census Bureau on local tax collections and what's collected.
Tyler will get the work done. Members of the committee, other questions?
Thank you.
I'd now like to call up Kristen Collins, Deputy Commissioner for the Virginia Department of Taxation, to give us an overview of Virginia's tax policies.
Hi, good afternoon, Madam Chair. Good to
afternoon.
see
Good to
everyone
see you again.
today. Good to see you. So before I start, I'm going to do a quick introduction. We have a new tax commissioner in Virginia. Commissioner Alex started in April. He's had the opportunity to meet a few of you already, but I just wanted to introduce him quickly because he will be in meetings with us, a new face, a lot of experience with E&Y, RSM, worked for U.S. Treasury implementing the Tax Cuts and Jobs Act, so a lot of great experience. So he's right there. So if you see him, that's our new
Would
commissioner.
you like to come up and make some remarks to us?
Sorry.
Thank you, Madam Chair. I appreciate the opportunity. Yes, happy to and appreciate the warm welcome that you all provided. My coming to the role of Tax Commissioner of the state of Virginia, I'm a Fairfax County native and went to school throughout all the years in Virginia, going up through law school at UVA. Then went into government and then private practice and back into government and private practice and now back into government here as the Tax Commissioner of the Commonwealth. So delighted to be here and honored, candidly, to be here to be the Tax Commissioner of my home state. So thank you very much.
Thank you very much. Thank you, Kristen.
Great, thank you, Madam Chair. And I'm going to do a brief overview of the types of taxes in Virginia and quickly go through kind of the top revenue sources, which Tyler pretty much already covered, so I'll skim over that fairly quickly. Then James Savage, our policy director, is going to cover individual income tax. Ryan Cunningham, our lead analyst, is going to cover corporate income tax. And Anna Duncombe, our lead on sales tax, is going to cover an overview of the sales tax. So This slide, and like I said, Tyler kind of already covered similar information, but just shows over time, our top 3 revenue sources are, like Tyler said, individual income tax, then sales and use tax, and then corporate income tax. So you can see they've pretty much steadily grown over time. In fiscal years 2020 and 2023, you'll see a slight dip in individual, and that's due to the tax rebates that were issued in those years. So the Department of Taxation, we administer most, but not all of the state taxes in Virginia. This is a list of the largest general fund taxes that we administer. So in addition to the individual, corporate, and sales taxes, we administer the insurance premiums license tax, the bank franchise tax, rolling stock tax, the estate tax, so that's mostly non-existent. It's only for individuals who died before 2007, and then the recordation taxes. We also administer a number of non-general fund revenue source taxes, communication sales tax being one of the larger ones, goes to localities, some of the cigarette and other tobacco products taxes, and then the aircraft and watercraft sales and use taxes, as well as a number of very small commodity taxes. And this is just kind of a list of taxes administered by other agencies, just to kind of give you an overview. So the ABC, SCC, VEC, Workers' Compensation Commission, DMV, they administer some of the other taxes in Virginia that our agency does not administer. And then to, I guess, tag on some of the questions a minute ago, here's some examples of some of the local taxes that are administered at a local level. Our agency does handle fiscal impact statements during the session, analyzing those bills. We generally don't provide revenue estimates, but we explain the potential impact and how the bills would work. Also, business local taxes, they have appeal rights to our agency, so we handle the appeals of those taxes. So kind of just a quick overview of how everything fits together. Now, James will come up and talk about the individual income tax.
I want to say hello, Madam Chair, members of the committee. James Savage from the Virginia Department of Taxation. And so I'm just going to speak to you today about the individual income tax, which we know is like the largest source and definitely of revenue, and also very important for it touches many taxpayers having to deal with it. And so the first question is basically like, who must pay this tax? Who has to file it? And we have some slides up there, and I think the key is that chart there where it has single or married filing separately. And so if you're about roughly under 12,000, you don't have to file and pay tax. And then if you're married filing jointly, it's roughly 24,000, and you don't have to file and pay tax. I should mention too, if you accidentally pay tax, like let's say the employer withholds it from your pay, you can file and get a refund in that situation. And so the final point I'd like to make sort of on this slide is the last bullet point there, businesses not organized as C Corps, such as partnerships, LLCs, and S corporations, that they pay tax on their profits at the owner level. So this is, most small businesses are paying the individual income tax. They're organized as LLCs or S Corps. So that's why, in part, it's such a large source of revenue, is that it's just, as many of you know, it's also business. And so turn into the next slide. So this slide shows our what do I want to say, income tax rates. And as you can see, it's we nominally have a progressive rate structure, but it tops out pretty quickly at 17,000 at 5.75. So most taxpayers in practice, especially because if you look before at the filing threshold, that those are so low. Because of that, most taxpayers are going to be hitting the 5.75% rate, and so they'll still get the benefit of the lower rates for the amounts they have below there. And so let's see here. Turning to the next slide, this is a familiar topic, the conformity, something Virginia recently did something with. Since 2023, Virginia has effectively, or generally I should say, rolling conformity, which means we automatically adopt any changes that Congress has made, with one important caveat, which I'll talk about at the bottom of this slide. What that essentially means is that we automatically pick up any changes that may happen, and so that's very different from what we did before 2023, where we needed to have legislation to address, conformity changes. And then the one big caveat to this, and there's actually two caveats, but the first one is Virginia did put, I kind of call it like we have rolling conformity with guardrails, because we have these revenue triggers. So if you can see like the last two bullet points here, any amendment that would increase or decrease general fund revenues by more than 50 million, we're gonna automatically deconform from, and then you all would have the opportunity to pass legislation if you decide it's a good idea to conform to this. And then similarly, they have sort of an aggregate revenue trigger that if Congress passes a lot of different things that maybe each of them are below 50 million, but in aggregate they're large, then there would be a deconformity and you all would have to pass legislation to address it. And then, so turn into the next slide. So that's about conformity generally. And then there are certain provisions where, in addition to all this, that Virginia has just decided, largely I think it's been because of revenue cost, Virginia has decided, hey, we're just not going to conform to this particular provision. And probably there's a lot up here, and a lot of these have kind of sunsetted. Some of them are related to COVID, and they kind of don't apply anymore. But there are a few that are very operative, and I'll kind of touch on those really quickly. Probably the first one up here, bonus depreciation. That's one I probably should mention. Under federal law, when you buy an asset, there are some rules where potentially you can deduct everything all at once, whereas up to everything all at once. There's various rules about it, but at the state level, usually we force you to depreciate it over the useful life. So you get the deduction, but it's sort of a timing thing. And so we've deconformed from that, and a lot of other states have because of it has a large revenue hit, but ultimately it's kind of a timing issue. And then the second one I wanted to kind of address on here is the reduction in the medical expense deduction floor. Both Virginia and the federal government allow you to deduct medical expenses if you itemize, but Virginia essentially allows you to deduct only when your medical expenses exceed 10% of your income, whereas at the federal level, it's 7.5. So pretty close, but it's a little bit less generous at the state level. And again, I think that was done for revenue concerns. So turn into the next. Oh, we're in this one here. This is a slide about the standard deduction, which probably many of you are aware of. And essentially, I always see this, it's sort of a flat amount of income that you can just take off your federal or state return. So a lot of people will call it kind of like it's a zero bracket. And what was I going to say? And Virginia, as you can see here, Virginia has, it sort of stayed steady for a while, but starting in 2019, there were various increases made to it. It went from like 3,000 and 6,000 to 4,500 and 9,000, and then there have been some more recent increases. But one thing to mention on all of this is that and I should say too, I kind of skipped over the first bullet point here. In the first bullet point, a lot of this was driven by the fact that the Tax Cuts and Jobs Act in 2017, it essentially doubled the federal standard deduction. So that's why one of the reasons I think Virginia, specifically in 2019, increased its standard deduction was to kind of address that. And but the key point here is that Virginia's standard deduction increases, just like the federal, are all set to expire in at the end of 25. So that's definitely, as you can see here in this slide, on the right-hand side, you can see it's kind of going to all go back to 3,000 and 6,000 unless action is taken. So turn into the next slide. So this slide we kind of put together, and it sort of provides a very basic example. This is sort of like a very simplified mini return, and sometimes I think it's helpful because when you talk about this stuff abstractly, it's I don't know, it just kind of is difficult to talk about. But the example here is that you have a married couple, let's say that they're over age 65 and they have $70,000 of retirement income. And let's just say hypothetically they have $100 of additions from municipal bonds from another state. So, and then $200 from bonds from which, for federal bonds, which Virginia can't tax. And so essentially this is how it would work for them on their return. Essentially, they'd start with the $70,000 that'd be copied right over from the federal return, and then they would add these sort of specified items. Basically, here they're adding this bond interest because and Virginia does this, and most other state, every other state does this. Basically, if you bought the municipal bonds of another state, what do I want to say? Our state will tax it because we're like, almost like you should have bought our bonds, and then you have to subtract out the federal bonds because bond interest because certain types we're not allowed to tax. And then also there's a deduction here for $12,000 for an age deduction. If you're over age 65, you get to subtract or deduct $12,000 off your return. And then also that $17,000, what do I want to say, standard deduction from the last slide. So they're married, so they're getting the $17,000 for 24, 25. And so as you can see here, that subtracts them all. So the tax they're actually paying, or the income they're actually paying tax on is just $37,400, and then you apply the tax rates. And then the last point is we're just assuming here to show you all how credits work, assuming maybe they had they were eligible for some sort of tax credit, then they would be able to subtract that out too after they calculate their tax liability, and then they'd have $895 due. So that's just kind of a very simplified example. There's obviously much more complications there. And then the final slide I'm going to handle before I turn it over to my colleague Ryan is just a quick discussion about everybody's favorite topic, the pass-through entity tax. That, as you may be aware, under federal law, under the TCJA, they did a $10,000 limitation on state and local tax deductions. And basically what's happening, and kind of explain the effect of all of this, essentially what's happening is that the workaround has been sort of was blessed by the IRS, where if you transfer the tax liability from the individual, and the individual is subject to this $10,000 liability to a $10,000 limitation to the entity is not subject to this limitation. So it was a way sort of to get around it, and the IRS said this is permissible, so that's why a lot of states, including Virginia, have adopted it. And this was, of course, assumed to be sort of revenue neutral because you're just switching who pays the tax, but not the actual amount of the tax. But there was a bit of an initial revenue increase related to essentially overpayments. Taxpayers were paying more PTET, probably because of the uncertainty of this, and then eventually refunds and everything. It seems to be gradually sort of stabilizing in that regard. But anyways, that's sort of the overview of individual income tax. I wanted to ask, before I hand it over to my colleague, Ryan, does anybody have any questions?
Members of the committee, questions?
Madam Chair.
Delegates? Okay, I don't know who's saying. I heard your voice. I saw his hand. So Delegate Sullivan, and then Senator Searle.
Thank you, Madam Chair. Mr. Savage,
And then I see in queue Delegate White.
your very first slide past the title page, who must file a return?
Yes.
Do you have any idea, either on a gross number or a percentage number, how many Virginians don't have to file a return as a result of these thresholds, of just being below these thresholds?
Yeah, what do I want to say, Madam Chair, Delegate Sullivan? We could try to look into it, but I think we might not have that because they're not filing, so we might not have that data. But we can definitely look into it and try to see if there's anything we could figure out on that.
If possible, I'd be interested. Thanks. Thank you, Madam Chair.
Senator Searle, and then Delegate White.
Thank you, Madam Chair. Mr. Savage, I had
Yes.
a couple questions relating to state line kind of stuff. So up where I live, a lot of folks work in D.C., earn their income there, and they live in Virginia. And also with the advent of telecommuting, a lot of people might work for a Virginia employer but not live in Virginia. And I'm trying to understand, as that happens, which state gets to tax that income? Because it seems like everybody I know who works in D.C. but lives in Virginia pays Virginia income taxes, even though they work in D.C. and for a D.C.-based employer. And so I'm trying to understand, especially as we get into this telecommuting, as that starts to become a bigger thing, more and more people that are, working for a Virginia employer but not living in Virginia, like where our exposure is on those kinds of issues. Can you explain those rules to me, because it wasn't clear in your slide?
Yeah, definitely, Senator Cervil. Yeah, and I didn't. What do I want to say? And it's interesting you bring up D.C. and Virginia, because that is a unique situation, because we have reciprocity with them, as well as Maryland and a few other states. So the general rule, like North Carolina might be the easiest to explain, because we don't have reciprocity with them. And essentially, basically, you pay tax to both states if it's, let's say, North Carolina and Virginia. And then if Virginia is, let's say, the resident state where you're, let's say you live, then we offer an out-of-state credit to kind of eliminate any double taxation. So that's the general rule. But there is a sort of an exception for some states that we have reciprocity with. And so Maryland and DC would both be that. And then in that case, it's the state where you are a resident, essentially you pay taxes to that state, and the state where you work agrees not to tax you, is sort of the system that's been set up.
On that, Madam Chair?
Follow-up question?
So when we were debating the Glen Dome, I remember there being some conversation about that when entertainers come into our state and they do a show in Virginia, that they have to pay Virginia income taxes. Or, for example, if there were a professional sporting event here and they were playing in Virginia or anything, they would have to pay Virginia income taxes. I mean, about how much of our income comes from that today? And is that generally what the rule is?
So I should say, Senator Cervil, that that's a great point. With respect to reciprocity, it only applies for wages from essentially like employment. If you're sort of, which I think, and I don't know the contracts between these, but if they're sort of an independent contractor, then the reciprocity rules do not apply, and then it's based upon a source basis. So if basically, to answer your question, if they were essentially an employee, then potentially it would go to the residence state. But whereas if they were not an employee, they were an independent contractor, then it should first go to like the state where they're doing the work, if that makes sense.
Okay, thanks.
No problem.
Thank you, Madam Chairman. I need a history lesson, and also I've only just recently understood, I don't know it all by any means, that Virginia does not have a standard deduction for a single head of household who is a parent of children, that we only have just married or single. Do you know the history of why we never adopted that? And how common is it among states, whether they conform with the federal interim of the single-parent family?
Yeah, Delegate Watts, that's a great question. I don't know it off the top of my head, and it is true. Like the federal government, they do have sort of an intermediate tier for the standard deduction. I forget I think
it's right in the middle.
Yeah, it's right in the middle. I feel like it was like about 18,000 under the tax cuts, and then it was 12,000, then 24. So in the middle, and I definitely am aware there are several other states that do have. I think we've seen head of household for them, but I don't have the. We can definitely look into that, but I don't have that right off the top of my head.
Thank you. I'd appreciate that.
Questions from other members of the committee?
Oh, thank you.
Thank you very much.
Madam Chair, members of the subcommittee, Ryan Cunningham.
I think you may need to raise your mic. That might be better.
All right. Is that better?
Yes.
All right. I'm going to talk to you just for a little bit about the corporate income tax. Kind of in contrast to the individual income tax, the corporate income tax, as you've seen on some of the information provided, provides a much smaller percentage of the overall revenue for the Commonwealth. Also, the corporate income tax can be more volatile in a given year. The amount we collect in corporate income tax can vary more than the income tax. And lastly, as the individual income taxes, we just saw there are several different rates depending on the amount of income you have. That those rates generally go up as your income goes up. But the corporate income tax is at a flat 6% rate no matter how much income that company has. Also, Virginia taxes the companies that are only in Virginia. They only operate in Virginia. They tax 100% of their income. All of that tax revenue comes to Virginia. But most corporations obviously do business in many different states. We refer to those as multi-state corporations. And Virginia only taxes a percentage of the total income of that multi-state corporation that is apportioned to Virginia. Apportionment really is just sort of a fancy way of saying out of the entire pie of income out of a particular company, how much does Virginia get? What is the size of the slice that we're taking out of that income? So we have a formula in Virginia to determine how big a slice does Virginia get. That formula is a three-factor formula. The first factor is property. That's generally calculated by the amount of property that company has inside Virginia versus how much their property do they own outside of Virginia. The next one's payroll. That's also how much of their payroll is inside Virginia versus how much is in all the other states. And finally, sales. How many of the sales of this company are inside Virginia versus the number of sales that are outside of Virginia. That last factor, sales, we double weight. That just means we count it twice in the formula. But as companies are very diverse, have many different business models, it can be sometimes difficult to have a one-size-fits-all apportionment method. And so Virginia does allow alternate apportionment methods for certain companies, for certain industries. Some of those industries include financial corporations, construction contractors, motor carriers, and railway companies. Virginia also allows companies to request if they believe that the standard method, that three-factor apportionment method I talked about, or maybe the method that we have assigned them isn't really equitable or isn't accurate reflecting their income to Virginia, they are able to request an alternative method of apportionment. One of the more popular alternative methods that is used by many other states is the single sales factor. As the name suggests, instead of using a three-factor apportionment method like Virginia has, they use one factor, only sales, to determine how much of this company's income, what size of the pie they get, or what size of the slice they get. They use only the sales. Virginia has adopted single sales factor in some limited situations. Those are for manufacturers, retailers, enterprise data centers, and debt buyers. In certain situations, we allow them to use the single sales factor method instead of that three-factor method that I described to you. The assignment of sales, how we determine whether a sale is in Virginia, can sometimes be complicated, especially when we're talking about sales of services or intangible property. Almost every state generally uses the same method for tangible personal property. Those are things you can touch, feel. The things you get in a box from Amazon, those are fairly easy to determine. The things you went out to the store, bought, and carried back to your house, those are sourced to the state where they're delivered, that location. So if something is delivered to a location in Virginia, that sale happened inside Virginia. And that's typically very easy to kind of pin down. But the sale of services and intangible properties can be a little more complex, a little harder to figure out. Currently, Virginia uses a method called the cost of performance method. And really what that says is when you have something that's intangible or a service, something that's harder to pin down, we source that to the location where most of the expenses or what it cost to produce this intangible good or this service, we trace it back to there. That's a lot of times the company's headquarters might be where most of the costs are taking place. So if a service or intangible good from a company that's headquartered in Virginia, often that will come to Virginia. But that's more of a sort of an all or nothing rule where you get, companies that are headquartered in Virginia, you get a lot of those intangible or services sourced to Virginia. But if they're headquartered in another state, then our cost of performance rule kind of means we won't get any of those, regardless of how many people in Virginia are taking advantage of any of those things. Many states have adopted what they call market-based sourcing as an alternative to cost of performance. And what that really does is kind of try to mimic what we're doing with the tangible personal property and try to apply that to some of these intangible ideas and saying if we could track down the customer in this situation, who's receiving this service or using this intangible personal property or intangible property, then where they're located is where the sale should be sourced. Virginia does use market-based sourcing in some very limited circumstances. For instance, for debt buyers, for property information and analytics firms, and for internet route infrastructure providers. The last thing I wanted to talk to you about today is how certain corporations file their tax returns. Affiliate groups, basically an affiliate group is a group of corporations all controlled by one entity. So how we treat these affiliated groups of corporations, is that we give them an option in Virginia on how they file their tax return. They can file separately. That means every corporation in the affiliated group files just a separate tax return, like they had no relationship at all. They just all file a separate return, and that's how they file. We also allow them to file what we call a combined return. And basically, they do the exact same thing they would have done under separate. Each company individually calculates their tax liability, and then at the end, they add everything together onto one return and just submit it together, almost more of kind of a convenience thing where the entire affiliated group can file one return, but they've all calculated everything separately. Now, the tax liability between these two, the separate and combined, is generally nothing. That it's really just two different ways of doing the same thing. As a result, Virginia allows most companies to kind of if they want to go back and forth between these two methods fairly easily. But in contrast, the last way we allow affiliated corporates to file is called consolidated. Or consolidated, instead of having each company calculate their tax independently, they add everything together at the minute. You just throw everything in the bowl at the beginning, all the income, all the expenses, the depreciation, whatever they have, all into one big pot. And what happens is that the tax liability for the affiliated group in a consolidated return can be very different than it would have been if they had all filed separately. Because of the difference in the potential tax liability, Virginia generally does not allow companies to go back and forth between filing consolidated returns and filing separate returns. There is, however, a statutory kind of exemption to that prohibition that allows companies to go back and forth between those two methods of filing. We've recently sort of loosened the rules on that a little bit compared to what they used to be. So currently the rules are that if you file in a particular manner for 12 years in a row and then would like to change, you may do so. If you file for 2 years under both methods, where you file as consolidated but then as also separate, and you pay the higher of the two for 2 years. After that 2 years, you can then file in the manner that you wanted to change to. If you have any questions, I'd be happy to take them now. And
Members of the committee? Questions? Is that an open chain? Oh.
All right, then I will turn it over to my colleague to talk to you about a little bit about the sales and use tax.
Thank you.
Madam Chair? Question?
I'm sorry, Delegate McNamara.
Thank you. More of a comment. The last two slides there was a lot of material on those slides, okay? and that's an understatement for sure. We touched base a little bit on single sales factor. We touched base on market-based sourcing, whether we're talking about apportionment or where the revenue's earned. You made a statement relative to market-based sourcing that many states, I think you said many states have gone to market-based sourcing from the cost of performance, which is our current model. Actually, I think that's 39 out of 45 states, and the rest of them don't have a state tax. But there were some bills in the General Assembly this past year that I thought were going to be referred to this committee to look at it. And particularly, I might request that this committee, before the calendar year is out, we take a look at apportionment and market-based sourcing, because we are putting ourselves at a tremendous disadvantage. It's not a tax avoidance strategy. It's not something that lowers our overall taxes, but it puts the Commonwealth of Virginia at a tremendous disadvantage relative to every single state around us, which has adopted market-based sourcing. It makes no sense for someone who is a service provider, which is what we are going after, to locate in Virginia when they're going to be taxed. Basically, Virginia's losing out on revenue over the long term, and so I just throw that out for the committee's consideration. I know there's a lot of pretty important things that we likely will disagree on, but I think there are a couple things that we likely will agree on if we really take our time and look at it and study what market-based sourcing really means. And single sales factor. I mean, every time we have somebody coming in, we change the rules to allow them single sales factor, because otherwise they won't locate here because they're at a competitive disadvantage. So, both of those things I'd offer up for this committee for consideration. Thank you very much.
Thank you. Questions by any other member of the committee? Okay, thank you.
Madam Chair, members of the committee, I'm Anna Duncombe for the Tax Department. I'd like to turn our attention to the retail sales and use tax.
Thank you.
Retail sales and use tax is applied to the sale, lease, and rental of tangible personal property, or the use and or consumption of the tangible personal property in Virginia. Customers and dealers share a dual responsibility for the payment of this tax. Customers are responsible for the payment of the tax at the time of the purchase, and the dealers are responsible for charging and collecting that tax at the time of purchase and remitting to the department timely. Although all sales tax is collected and remitted directly to Virginia Tax, a portion of that is distributed to localities where the sale is made. Remote sellers and marketplace facilitators are required to collect the tax if annual sales made or facilitated to Virginia customers exceed $100,000 or 200 transactions. Use tax also applies to tangible personal property purchased outside of Virginia, but used, consumed, or stored in Virginia that would have been subject to the tax had it been purchased in Virginia. Over the last 50 years, the statewide sales tax rate has gradually increased from 2% in the 1960s to the current rate at 4.3%. During that time, statewide rates applicable to certain types of property, including food, personal care products, have been reduced or eliminated. A handful of localities have also been empowered to implement their own additional sales tax for funding of transportation initiatives, regional tourism, and school construction. There are around 30 localities that have been authorized to impose this tax. Statewide, the total state and local tax rates vary from 5.3% to 7%. In addition to tangible personal property, sales tax is also applied to limited services, as well as services in connection with the sale of tangible personal property. Transactions involving pure services with no tangible deliverables are generally not taxable. Services provided in connection with tangible personal property are taxable unless there is a statutory exemption for that service. In addition, the following services are taxable: services in connection with the fabrication of tangible personal property, services in connections with serving meals, and rooms, lodging, and accommodations furnished to transients for more than 90 days. Some services are deemed non-taxable and are specifically exempted from the sales tax. Those include personal, professional, or insurance transactions that involve sales as an inconsequential element and for which no separate charge is made, separately stated services performed by repairmen, separately stated labor or service charges for the repair, installation, application, or remodeling of tangible personal property, separately stated transportation charges, separately stated charges for alterations to apparel, clothing, or garments, and charges for gift wrapping services performed by a nonprofit. Goods available in digital or electronic formats are generally not taxable. Computer software and software-related services that are canned or off the shelf are taxable if they are delivered in a tangible format. So that would be a DVD, a CD, something that you are receiving from the purchase. However, if it is delivered by email or if a key is supplied that facilitates a download, the software is not taxable. Amounts separately charged for labor or services rendered in connection with the modification of pre-written software programs are not taxable. And custom software is not taxable regardless of the method of delivery. In order to be custom, the software has to be developed from scratch. Software as a service, such as cloud computing, is considered a service and is not taxable. That's a lot of information. I'm happy to answer any questions.
Questions by any member of the committee? Delegate Watts, you in queue? Yes. Okay.
Thank you, Madam Chairman. My question is pursuing, as you laid it out, Madam Chairman, the proposal that was made to modernize our sales tax, extending it to the digital products and services. What I would like to have considered by this group is way back in 2012, JLARC pointed out that we should be considering looking at the broader taxes of a number of services, given that in 1970, which is now 50 years ago, the average family began spending more on services than goods, and it's now 2 to 1.
Yes.
So I would very much, as we look at modernization of our sales tax and equity of it falling on who has discretionary income and can pay for a number of services while people are continuing to pay just on goods, that we add that as we added other items to our agenda.
Absolutely, and as a matter of fact, that had been my hope as well. Questions, Senator Eben?
Thank you, Madam Chair. Maybe we'll have this, maybe we already have this information, but I'm just curious, do you know if canned or off-the-shelf software that's taxable in other states, if there's the stuff that's delivered via email is not taxed like it is in Virginia? Is that common in other states, or do most of our neighbors or other states tax non-tangible software?
There are some states that neighbor Virginia that do tax that type of software that is downloaded and there is no tangible element to it. I do not know off the top of my head, but we could look into that.
Thank you. Thank you, Madam Chair.
Other members of the committee?
Madam Chair.
Questions? Okay, I didn't see anybody in queue. Senator Servo, Delegate Sickles, anybody else? Please put it in queue. Servo?
Thank you, Madam Chair. I'm glad to see our system's working. It doesn't, downstairs you can't, the queuing system doesn't work, so I'll start using that. I had a question about, I'm not sure if it's for you, but it was something that's not mentioned in this overview of Virginia taxes, which is, does anybody have any idea how much revenue we lose to people not paying their taxes? Because I know at the federal level, there's been a big push to try to enhance federal revenues by having better tax compliance. And I know one of the focuses we had in this year's budget was to put more money into audit positions, because the more money we spend on audits, the more money we actually collect. And so as part of, looking at this, I was just curious about that. Do y'all have any idea how much money we're losing by people cheating?
No, I don't think we do. That would be difficult to determine, but we could look into it.
Okay, if somebody back there can maybe look into that for me, I'd appreciate that. Thank you.
Delegate Sickles.
Thank you, Madam Chair. Just have a small question on the statewide rate of 5.3%. That includes 1% that goes back to the locality where it's raised, right?
Yes, Delegate.
Okay, so it's not really a statewide rate per se. At one point in 50s or 60s, the local governments decided to add another penny to it. Is that correct?
I believe so.
Okay. Thank you, Madam Chair. I mean, it has policy implications, once we start distributing it, because we had issues with that a year or so ago. Thanks.
Questions by any other members of the committee? Wrong one? Thank you.
Thank you.
Okay, that appears to finalize the part that we have on an overview of Virginia's tax policy. So at this time, I'd like to have a review of options to make Virginia's individual income tax more progressive. And I'm going to call on Justin Brown, who is the Senior Associate Director for the Joint Legislative Audit and Review Commission. Thank you.
Good afternoon, Madam Chair and members of the subcommittee. I appreciate the opportunity to be here. I had been asked to talk for 20 minutes. Does that still sound about right? I know you all have had a long day. Oh, wow. Okay. More taxes. Okay. Well, feel free to dig in on any of this. Yeah, which is great. So let's see. This was actually something we were asked to do back in 2021, and it was actually a study resolution introduced by Delegate Watts. And as you can see, we put this report out, what is almost now 2 years ago now, in fall 22. And at the time, we briefed our commission, and then I believe I came and gave a presentation to maybe a prior iteration of this group about this particular report. So happy to be back. And I'll just give the obvious caveat here that this information is 2 years out of date. So I think the general principles still hold. I think the percentages are going to be in the ballpark. But certainly in terms of dollars, given kind of the continued increase in revenues and inflation, it's going to be a little bit different. But I think the main concepts work here. So with those caveats, back in 2022, we had a few kind of key takeaways across this work. The first is we identified 11 ways you could make the income tax more progressive. Now, some of them are pretty similar, but the highest organizing framework was 7 of these would make the income tax more progressive by lowering taxes on low and middle income filers, so kind of at that low end of the income curve. The remaining 4 options we have would make the income tax more progressive by raising taxes on higher income filers. So these options that we identified really would kind of change progressivity in different ways, but also to much varying degrees. So we had things that would make the income tax more progressive by just a few percentage points, and a few big changes that would double it, 115% more progressive. As was mentioned earlier, obviously the individual income tax is the primary source of revenue for the Commonwealth. And so when you begin to change that, you can produce some fairly substantial increases or decreases in income that comes into the general fund. So the options that we identified as possible changes, you could collect 6% more revenue, but you could also collect 6% less revenue. So the last thing I'll say about this, in the interest of time, I will not go through all 11 of these options. We have a report on our website, and I'm happy to provide hard copies if folks are interested. But I will kind of just hit some of the highlights to give you a flavor of the different types of options that we had. So I don't expect anybody to be able to read this. It's a very busy chart. But again, this just shows you the 11 options. And I just wanted to show you that to maybe orient you to this a little bit before I dive into this. We focused on a couple of things. We had 2 different measures of how progressivity would change if you implemented the option. And so that's kind of those first 2 columns. I'll explain what those measures are in a second. We also just wanted you to really understand that if you did this, which income groups would you be kind of affecting the most by making the change? And then the state revenue up or down is kind of that last column. So I have the luxury of being able to skip this because the tax department reminded you what the actual rates and brackets are. So these are just the rates and the filing thresholds. So progressivity is an interesting kind of public policy concept. There's different definitions of it, but kind of the idea is the same. So the concept is that higher income filers should pay a higher percentage of their income in taxes than lower income filers. And when you talk to kind of interest groups that are real proponents of progressive taxation, they say that the reason a tax should be progressive is because as you have more income, you have more disposable income that you don't have to spend on essentials. And so the bottom table here, I'm just kind of showing you, I don't want to offshoot into a whole discussion of income disparity, but there are obviously differences, and I think widening differences in income levels nationally and in Virginia. So this just gives you an example. So as of a couple of years ago, the top 20th percentile of Virginia income, it was $287,000. That was 53 times the bottom 20th percent. So just this notion in terms of progressivity, the proponents of this concept try to kind of understand and maybe address through this policy is the large disparity and typically increasing disparity between high income people and low income people. So the idea of progressivity is fairly easy to understand. Quantifying it in the way we wanted to do it was a little tricky. There's some experts that come up with different ways of quantifying it. We looked at, I think, like 11 or 12. We settled on these two, and we feel pretty good about using them because they show kind of different things. So the first one I'll talk about is what we just call the progressivity index. It's based on an academic measure, and that treats all income tiers equally. But the other one is something that we call the high-low rate gap. There's other people that call it something slightly different, but it basically takes the effective tax rate of the top 1% and compares it to the effective tax rate of the bottom 20%. So looking at just kind of the distribution from very low to very high income. So the bigger difference you have, the more progressive your tax system is. And I'll give you some examples of this, but these are fairly common measures, and they kind of show you the same thing, but in a different way. These dollar amounts are going to be a little bit out of date, but I think it's interesting to look at the distribution of income. This was probably as of 2021 tax filings or something like that. But when you apply kind of a standard statistical distribution to it in terms of quintile, so that's the 20%, and then when you chop that top 20% up into different groups and look at that 1%, you can see, what you might say high or very high income, and this is annual income, not assets, annual income, about $600,000 annually. And then you can see the distribution kind of down from there. But it is a very wide range in Virginia. So I will go through this quickly, but I did want to just remind everybody, and it has already been mentioned, there were some changes made by you to make the income tax more progressive back in 2022. And that happened while we were doing our work. You increased the standard deduction, and you made 75% of the earned income tax credit refundable. And when you talk to experts in tax policy, they say if there's one thing you can do to affect progressivity, it's fully refundable earned income tax credits. So those were big changes, and I'm going to use this construct kind of repeatedly. So this is just showing you how the progressivity kind of measure by income group changed after you made those changes in 2022. And you can see that in those top income tiers, which are along the bottom, nothing really changed. But what happened for certainly the bottom 20%, but as well as that second 20%, they went from owing a little bit of tax to getting effectively a rebate. And so you can see that dark line drops, particularly for the bottom 20%. So those changes from a progressivity perspective were big steps. I do believe without action, these kind of go away in 2025. Do I have that right? So that's something important, obviously, to keep in mind. The other thing that I'm going to kind of refer to here as I go through this is how various changes would affect these two measures. So The progressivity index, that's the one that is looking at all income tiers. The changes you made in 2022 had a pretty big bump there, a 45% increase, and a similarly big bump, but for a different reason, on that high-low rate gap, which went up 48%. So that just kind of measures the change in progressivity in a quantifiable way. So there's a lot of interest in how we compare to other states. There is a group that every few years compiles a lot of information and ranks states on taxation and a lot of different things. We use the income tax part of that to get a sense of how Virginia compared to other states. And what we're showing you here, at the time, the latest comprehensive data set was 2018, so it was pretty old. And we just checked, and there's a new one that's come out over the last couple of years, so this will be different. But what we're showing you here is the changes you made in 22 really, from a progressivity perspective, made a big difference and kind of moved Virginia kind of into the conversation in terms of income tax progressivity. So let me walk you through some of the options we have. The first option we had is a simple concept that's just kind of continuing the concept of a refundable tax credit by going from 75% to 100%. And what you see here is on that curve, nobody's really affected except the bottom 20%. And obviously, lower income filers will see more when they file if you were to do this. It doesn't really do much in terms of our measures here. And part of that is because once you made it refundable and made 75% of it refundable, there's not that much more left to do there. The other thing to put this in context is relative to the options we had in the report. You can see that this change would increase the progressivity index by 2%. We have something later that would increase the progressivity index by 115%. So this would be a fairly marginal change in terms of progressivity. The other thing, because the folks in this income category obviously don't pay much or contribute much to the total revenue, there's a small decrease in revenue by doing this, but not a big one relative to some of the others, which I said would be plus or minus 6%. So this has been a topic of conversation, obviously, in the legislature for a long period of time, and this is not news to anybody. I believe it was in the whereas of the resolution that Delegate Watts put in. As I'm assuming all of you know, the income kind of brackets have not changed since 1990. And, for a year or two, that's not a big issue. But over time, it does have a really big impact because of the effect of inflation. Income goes up, but the brackets don't change. And so one way to quantify this is how much of the median filer's income is being taxed at that highest threshold of $17,000 and 5.75%. And all I'm showing you here on this table is you can see back in 1990, none of that median income was taxed at the highest rate bracket. By 2021, 47% of it was. So what's happening here is it's really this concept of bracket creep. It's really affecting the people at the low end as their incomes go up, but the brackets stay the same. So just to kind of bring this point home and quantify the long-term effect of this. Again, this is a couple years old, but the idea here is the same. So between 1990 and 2021, the median tax owed increased 173%, but the median income only increased 108%. So that dark area between those two lines, if you wanted to think about kind of quantifying the impact of this bracket creep, that's one way to think about it, that differential. So one option that you could think about is to, and I don't think there's anything magic about the dollar amounts even back in 1990, but just for discussion purposes, if you wanted to just adjust the current brackets for inflation since 1990 and kind of catch up or compensate for that change over time, what happens here is, everybody's rate goes down to some degree, but especially for lower, middle, and middle income filers. And what happens is the progressivity index would go up by 23%. That high-low rate gap doesn't move much at all because the high and the low drop by about the same amount. But what happens here is because it's a lot of years of catching up because the brackets have been the same for so long, it's quite expensive. Doing this would cost about 6%, which at the time was about $1 billion. So that's going to be more now. So that's a big change. You know, if you wanted to kind of take that concept and combine it with something else, this table just shows you that you could kind of update the brackets, but then also apply a wider dispersion among the rates. And the concept there, when you look at some other states, is you try to get a bigger spread between the high and the low and kind of differentiate more in terms of the rates between low income and high income folks. So that right hand part of the table is just a kind of an idea for if you wanted to come up with some new brackets and some new rates, just to give you an example of how that would look. And you know, that 6.5% we got because that was kind of the median other state rate. But you know, this is where you start to get some interesting things, and there's some tough policy choices maybe in terms of how you go about achieving the progressivity. So this just shows the difference where you see kind of the effective tax rate of the upper income groups going up, and you see kind of a dropping for the lower income groups. There's a lot of different ways to do this, but that's the basic dynamic here. So you start to see some big movements in that progressivity index measure where it would go up 57% there. What happens here is this costs a lot less than the one I just talked about because you're collecting more revenue from higher income filers to kind of backfill the revenue loss by this updating the brackets for inflation. So the last group of options we have is you could just kind of raise the rates on upper income filers. So before I jump into these options, let me just give you a little bit of context on rates. And this probably has changed a little bit, but I think it generally holds. So I mentioned earlier that Virginia's 5.75%. It was a little bit less than the median high rate across all states, which was 6.5%. And just to give you some perspective, you know, on kind of, I guess, the really high end, those sub-bullets there, you know, there's some complexity to this, but, you know, you've got California, New Jersey, New York. They're up in kind of the double-digit area for high-income people, but the way they define income is obviously much higher than our $17,000. But that's just an example of how high some of these rates get in percentage terms. So just a little closer to home, this is kind of the surrounding states. It's interesting. A lot of times it's like we like to look for kind of regional patterns. There's really no pattern here. It's a little bit all over the map. It is interesting that North Carolina, you know, went to this flat tax, and they also changed a variety of things. They added some more credits on the low end, but this just shows you kind of how West Virginia, Maryland, D.C., and North Carolina structure their income taxes. So one idea would be to add a new kind of tier for folks in the top 1% income bracket, and that's going to be $600,000 or more in annual income, give or take. And you could just apply a 7% rate to that. And you know, this would obviously affect just those in the top 1%. And you can see there'd be a 15% increase in that overall progressivity index and 11% increase in that low rate gap. What's interesting here is there's enough kind of income in the state if you wanted to get it, that would push revenue up by 2%. So at the time, that was about $400 million. It's probably going to be a little bit more than that now. And you wouldn't do anything on the low end. If you wanted to go a little bit more in that same direction, this is just showing you if you kind of did a 9% rate for that top 1%, so the 600,000 or about and more. This shows you how that would look. And what's interesting there, that increase from 7% of income to 9% gets you 6% of revenue, and that's going to be more than $1 billion. So I will close, Madam Chair, with kind of a maybe simpler, almost good government idea here that harkens back to this concept of bracket creep. It's obviously kind of expensive from a revenue side to update those brackets and compensate for what's happened since 1990, but you could just kind of update it moving forward and index it. And this is just showing you the same idea here in terms of how that growth has kind of occurred. And it's interesting, the federal government indexes its brackets. At the time, there was 24 states who have an income tax and have a graduated tax structure. They periodically, there's no discussion about it, it just kind of automatically updates the dollar brackets based on inflation. So this is a fairly common thing to do. And so we, we had kind of a specific option that if you wanted to kind of address progressivity moving forward and kind of stop this, I would say, slow, steady tax increase on low-income folks due to inflation, you could think about just doing this moving forward at whatever the rates are. And that would at least preserve the degree of progressivity you have as of now. And inflation wouldn't periodically kind of result in that slow, steady tax increase. So this is just all the options again. And those are, again, all online in our report. Happy to answer any questions. But I think I'll leave it there, Madam Chair.
Well, I think you have some questions, and as soon as I looked to my right, I saw Senator Obenchain. So Senator Obenchain, it's you.
Yes.
And then there's going to be Delegate Watts and Senator Searle.
I know that your data is a couple of years old on your recommendations, and you know, I have a hard time thinking in the abstract with these low, middle, high, very high income brackets. And you know, I took the simple tax return that Department of Tax did, and was trying to look at how progressive our current tax code is. And you know, they took somebody with federal adjusted gross income of $70,000 and using their simple tax filing, they came up with an $895 tax due to the Commonwealth. So that person would be paying about 1.27% of their federally adjusted gross income. I then went to somebody making $150,000 using the same basic deductions, and it looks like they're paying about 4%, about $58.33, and then went up to $200,000, and that person would pay about 4.7%. And a lot of that changed when we changed the standard deduction, increased the standard deduction. And it seems to me, just from looking at these figures, that by changing the standard deduction, we pretty significantly increased your progressivity index already in the Commonwealth of Virginia. Is that an accurate read and understanding on my part?
I think that's accurate. I think that those two changes in 2022, raising the deduction and allowing low-income people to get a refund even if they don't have actual tax liability, those two things together really brought Virginia from what I think kind of nationally was viewed on the income tax side as maybe not that progressive to kind of, you know, in the conversation for being more progressive. So we had a slide earlier, I guess I can't bring it up, but we showed that those measures, as you say, based on that one change from 21 to 22, that was a big improvement in progressivity. That's very true.
Madam Chair, and I may be asking you to get perilously close to speculating or making a guess, but can you give me some kind of a estimate as to the percentage of change in the progressivity index that the standard deduction change made?
We have that somewhere, I think. I can get you that. I think, you know, it's interesting. They operate in different ways, and you said it quite well, actually. So that standard deduction is kind of available for everybody. So that had the effect of reducing, or, you know, kind of addressing the progressivity issue for people well up into the income curve, to your point, in terms of 100,000, 150,000. The earned income tax credit, it's more valuable to people on the loan, but that's a smaller group of people. So we can get that quantification to you. But I do think you're look at the service here. This is
How about
great.
that?
So yeah, what would you? This is Ellen Miller who did all the work on this. What would you say about that?
So it was a 45% change in the progressivity index.
The two together.
Between 21 and 22. Yeah. And then for the high-low rate gap, it was a 48%. So it wasn't our. Yeah.
So the point would be, because those two measures changed about the same, but they measure different things, this gets complicated. they probably had about an equal effect on progressivity in terms of percentage terms. Am I saying that right?
Yes.
But just affected different people. I think it's, you know,
Yeah. And one other thing to keep in mind is that the standard deduction was increased again. So it would increase a little bit more.
okay, so it's even a little higher.
Yeah. Okay. Because our analysis is based on 8,000 standard deduction, but it increased again.
That's right, because I believe there was a clause that said if revenue came in, it would buck up a little more. I think that's right. I'm glad you said that. Yes.
Follow up by Senator Auburn-Jane.
We were looking at these options back, say, 3 years ago, 5 years ago. Raising the standard deduction to its current state would have had a bigger impact on the progressivity index than even imposing a 10% income tax increase on the very high income
it would
individuals
depend
in
on which
Virginia.
measure, and this gets back to kind of the philosophical of what part of the income tier do you want to accomplish the progressivity through. So to your point, you can use those different measures to make that case, but I think you could also make a slightly different case if you worried more about the low part of the curve. But what you said is not incorrect.
Thank you.
Delegate Watts?
Thank you very much, Madam Chairman. Actually, I'm very fortunate to be following Senator Auburn-Jane's line of questioning, and now I will zero in differently than I would have. I want to be sure that I understand on 17 that this bracket, this income bracket creep, et cetera, when you say income, Virginia median income, are you talking about taxable income, adjusted gross income, or actual income before you start figuring your taxes?
Data people, do we remember this?
I want to say
It's been 2 years since we did it, that's why we're... I think in the model, everything was adjusted gross income. Does that sound right?
This is not from the model.
Oh, this wasn't from the model. Okay. I'm going to have to get back to you. But to your point, it will make a... Your point is that matters a lot, correct? As soon as we wrap up, I can read the footnotes and find that out. That's a key point.
For that, needing that clarification to make sure I'm looking at this properly, because when I look at it, if I raise the standard deduction and even index the standard deduction and nothing else, I have constantly raised the base at which you pay no taxes, which means the effect of any of our rates are also, it's this rate on 17,000, but actually your take-home income was this, and we've now given you a much bigger standard deduction, and you don't start paying taxes. So I don't have to raise the rates if I've raised the point at which you start applying those rates. And so this is why I really needed to have that clarification, because that's where my mind says I have the biggest target on progressivity is to raise that base as incomes increase of where you start paying taxes, so it's a comparable basic living that we're not taxing.
So if I might, Madam Chair, two remarks. I'm looking at our footnote here from this table. This is Virginia income, and it's some census data. So I think this is going to be before taxes are filed.
And so taxable income would be considerably different.
That's right. And then to your point, this is all a bit of an algebraic equation in the sense that you can do things as you're pointing out, like indexing the deduction. You can index the filing threshold. There are things you can do to have the similar effect that aren't just about the rates. The concept is anything in tax terms that is in dollars, not percentages, over time tends to be too low. And so right now, pretty much everything about the Virginia tax code is dollars. Filing threshold, the standard deductions, and the brackets. And so your dynamic, the way you're thinking about that is correct, in that you can accomplish this objective by adjusting a variety of parts of the tax code, if I'm saying that clearly.
Thank you.
Yeah.
Senator Sorrell?
Thank you, Madam Chairman. Somebody once told me, I think might have been Senator Peterson, that Harry Byrd insisted that Virginia imposed an estate tax at the same time we imposed an income tax, because he thought it was unfair that we tax live people's income, but that we allow them to evade income taxes by passing it through their estate, because the cap gains aren't recognized or whatever, it's all built up, and so they thereby avoid paying income taxes on whatever wealth has been accrued in that estate. And I know we repealed our estate tax in 2007. Is there some reason you all didn't look at that as one way to restore progressivity to the way we tax income in this state?
The only reason we didn't was because we were asked to look at the income tax. But to your, and for example, there are changes that could be made to kind of the way that business income is kind of filed and taxed. You could put an estate tax back in. This resource that I mentioned that every few years puts out kind of a national data set has information about which states have estate taxes. I'd be happy to get that to you. But to your point, I think that kind of unquestionably would have an effect of increasing progressivity when you look across all types of taxes. So that's
Right.
that's a
I have one additional question, Madam Chair.
Senator Sorrell?
So I think you said 1994 was the last time we adjusted the brackets.
1990, but yeah.
90. And you framed most of your stuff in percentages on these, or all of it, I think, in percentages in terms of your slides. Do y'all have any sense of how much additional revenue we would have coming into Virginia's system if the brackets had kept up with inflation, since 1990 in terms of actual dollars?
Well, what's interesting here, this may be a little counterintuitive, but as you, tell me if I'm saying anything incorrect, if you index, you actually don't collect as much income. And that's why if you were to kind of correct for the effect of inflation since 1990, it reduces state revenue by about 6%. And that's because you're kind of, by using dollars for such a long period of time, you'll understand this very well. The 17,000 now doesn't buy you what it did back in 1990. So overall incomes tend to go up so people can afford to live. So by raising the brackets, or some of the things Delegate Watts is talking about in terms of indexing standard deductions and filing, that actually has the effect of collecting less tax revenue.
Okay, Madam
Did
Chair,
I say that right? Okay.
I have one last question based on that. So the chart we saw about an hour ago now, which showed that Virginia is increasingly reliant on income taxes over the last 20 years. Would you say that our failure to index our tax brackets is one of the major reasons why we are more reliant on income taxes and other taxes? And I recognize there's also been a decreased sales tax base and other reasons why sales taxes have been shrinking, but is this failure to index partly why we're more reliant on income taxes than not?
It could be. I think in order to really answer that question, you'd have to know kind of what's driving the changes in all the other types of taxes and how that contributes to the total amount of general fund revenue that's collected. Yeah. But I think as you say, you could accurately state that had the state indexed the brackets, let's say starting in 1995, and just periodically done that, there'd be less coming in terms of that income tax revenue. And so the total amount of revenue would be less. How that would interplay with the other taxes, it gets complicated.
Got it. Okay, thank you.
Delegate McNamara?
Thank you, Madam Chair. Just a comment on the regressivity that we didn't have covered in this presentation. And I would say that, when we talk about increasing the progressivity of the tax code, I think everybody on my side of the aisle will be more than happy to sign up as to lock in that standard deduction, which I will say we had bipartisan support in the House last year to remove that sunset date. But the other thing I would just like to point out that kind of gets lost in this, I don't believe we are really running our Commonwealth on the backs of poor people, Because if you look at the 5 quintiles of tax returns, the bottom quintile, which is the 0 to 20%, actually pays negative taxes with the earned income credit in the totality. The next quintile pays 0.2% sales tax based on income in totality. So the bottom 40% of taxpayers are actually not taxpayers. So now we're talking about making things more progressive on the 60%, not the 40% that already are not paying any money. So I would like to point that out because services do cost money. Thank you, Madam Chair.
And Madam Chair, if I might, I'm glad you brought that up because, again, this gets to kind of how one defines progressivity. But when you look at where the current tax revenue comes from, it is, heavily skewed towards higher income earners. There's no question about that. I guess the philosophical discussion comes in, and I don't have a dog in the fight in this. How do you kind of adjust that? But the dynamic you point out is absolutely correct. I will say, just to harken back to something that was asked a while ago, we tried to estimate how many people don't file, not necessarily for fraudulent reasons, but because they don't make enough to file. And that is relevant in terms of progressivity. To Delegate McNamara's point, about 10% of people was our estimate there. So I think that question was asked earlier. It's probably not perfect, but that's probably in the ballpark. So.
Any further questions, Senator Obenchain? I shall.
In terms of looking at progressivity, I mean, the one big glaring omission in this analysis, in my view, is that from the taxpayer's perspective, taxes are taxes, okay? It doesn't matter whether they're income tax, excise tax, sales tax, cigarette tax, whatever it is. And, when you're looking at what the most regressive of the taxes are, it is the cigarette tax, the gas tax, the sales tax, all of those taxes. So wouldn't it make sense to look at not just income tax, but at all taxes in order to make any real difference on making our tax system in Virginia less regressive, more progressive? And, I'm concerned every time we talk about, an increase in cigarette tax, I mean, whether it's, a health problem or not, I mean, the fact of the matter is it falls disproportionately on poor people in Virginia, same with sales tax. And I just wonder whether maybe we're missing an opportunity to look globally at our tax system and to make a real difference rather than it seems like we're just focused on, a subset of the taxpayers in Virginia, figuring out a way that we can, get more revenue from higher earners without looking at how we reduce the tax burden globally on lower earning taxpayers in the Commonwealth of Virginia.
The only thing I would add to that is some people have said the same thing, for example, about local real estate taxes, to your point that they don't really distinguish kind of which level of government is collecting. And I will say that this group that collects this every 3 or 4 years actually does a progressivity measure across all forms of taxation. And I'd be happy to give that to the committee staff if you'd be interested in looking at it. It gets kind of complicated, but that's a valid point. Looking at all the forms of taxes, they all have an up or down in terms of progressivity or regressivity. That's very true.
I'd like to see a copy of that.
Sure, be happy to do that. Yeah.
Well, I think we had a very robust introductory meeting here, and I think we're off to a good start. And I just want to thank all of the presenters because this is exactly what we needed to hear. And so as we go forward, I hope that everybody will have all their thoughts on the table. But at this point, if there's no further business, no further questions, committee shall rise.
Thanks for the audience.
Senate of Virginia, Richmond, Virginia.